You have been paying for something your entire adult life that is specifically designed to not work when you need it most. And I don't mean that as a metaphor, I mean that literally, mechanically, by design. The way a vending machine is designed to take your dollar and give you a snack, the insurance industry is designed to take your premium and find a legal reason to give you nothing. Here's the number that broke the internet and then somehow got forgotten 2 weeks later. United Healthcare, the largest health insurer in the United States, pulling in over $370 billion in annual revenue, denied approximately 32% of all insurance claims it received. Nearly 1 in 3. And here's what nobody in that news cycle told you. That number isn't a scandal. It's a quarterly earnings strategy. Stay with me, because by the end of this video, you're going to understand exactly how the machine works, who built it, why it's legal, and, most importantly, the 5 specific moves you can make right now to fight back. This isn't a rant. This is a blueprint. Let me paint you a picture. You've been paying $400 a month for health insurance for 11 years. That's over $52,000 out of your pocket. You haven't filed a single major claim. You've been, by every measure, a dream customer. Then one day, you actually need it. Maybe it's a surgery, maybe it's a cancer diagnosis, maybe it's just a hospital stay that nobody planned for. And the letter comes back. Denied. Not because you lied on your application, not because you missed a payment, but because somewhere in a 60-page document you signed a decade ago, there is a clause, written by lawyers, for lawyers, that gives a company the legal right to take your money for years and then walk away the moment the relationship becomes inconvenient for them. Now here's the thing that most people miss when they hear this story. They assume it's a bug, a broken system, a few bad actors operating in an otherwise fair industry. It's not. The denials aren't a malfunction, they're the product. And to understand why, you need to understand how insurance companies actually make money. Because once you see the math, everything else makes sense in a way that should keep you up at night. In about 60 seconds, I'm going to show you a 119-year-old playbook that insurance companies invented, and still use today, to legally void your policy the moment you get sick. It's called rescission. And it's more common than you think. Insurance companies make money in exactly 2 ways. First, they collect premiums. Your $400 a month, your employer's $800 a month. Every premium from every policyholder in their portfolio. Second, they invest those premiums in the market while holding them. Every dollar they collect sits in an investment portfolio generating returns before it ever gets paid out. Now here's where it gets interesting. Every dollar they pay out in claims is a dollar they didn't get to invest. Every denied claim is a dollar that stays in the float, generating returns. The industry has a term for this. It's called the combined ratio. A combined ratio below 100% means the insurer is profitable on underwriting alone, meaning purely from collecting more in premiums than they pay out in claims. In plain English, your denied claim is a profit line item on their quarterly earnings report. And this isn't speculation. This is how every publicly traded insurer explains their business model to shareholders. Aetna's denial rate? 22%. Cigna? According to reporting by ProPublica, internal reviews were lasting as little as 1.2 seconds per claim, using automated AI systems that flagged and rejected claims faster than any human could read a patient's name. 1.2 seconds. That is not a review. That is a rejection assembly line. And yet here's the number that should make this personal for every single person watching. The 5 largest health insurers in the United States, United Health, Elevance, CVS Health, Cigna, and Humana, generated a combined profit of over $35 billion in a single recent year. In a good year? In a bad year? In a pandemic year? The profits are structurally protected because the product is, in practice, mandatory. You cannot get a mortgage without homeowner's insurance. You cannot drive without auto insurance. You cannot access most employer benefits without health insurance. It is the only consumer product category in existence where the government functionally compels purchase while allowing the seller to determine unilaterally whether delivery is required. That is the foundation of the machine. Now let me show you the tools. There's a woman I'm going to call Karen. She paid premiums for 9 years, never filed a major claim. Then she got breast cancer, and the insurer found something in her file from 2 decades ago. I'll tell you exactly what it was and what it cost her in just a moment. The rescission clause is only one tool in the toolbox. Let me walk you through the full arsenal, because this is where the sophistication becomes almost impressive. Rescission is the practice of retroactively canceling an insurance policy after a claim is filed, by combing back through the original application for any material misrepresentation. And when I say material misrepresentation, I don't mean fraud. I mean, you forgot to mention that your doctor once asked about your cholesterol at a routine checkup 7 years ago, or that you were briefly prescribed an antidepressant in your 20s that you took for 3 months, or that you answered no to a question about back pain because you interpreted it as chronic pain and they interpret it as any pain. That's enough. Policy canceled, premiums not refunded, claim denied. Rescission was so common and so egregious that Congress specifically tried to ban it in the Affordable Care Act of 2010. And insurance companies responded by doing what they always do. They hired better lawyers. Rescission didn't disappear. It got more creative. Prior authorization forces your doctor, a trained medical professional who went to school for a decade to treat you, to get permission from an insurance company bureaucrat who has no medical training and is partly compensated based on denial rates before performing a medically necessary procedure. You read that correctly. Your doctor recommends a surgery. An insurance company employee with a checklist decides if your doctor is right. Step therapy legally requires patients to fail on cheaper, less effective treatments before an insurer will cover the treatment their actual doctor prescribed. Your oncologist wants you on drug A. The insurer requires you to first try drug B and drug C and document that they didn't work before they'll approve drug A. In cancer treatment, that delay can cost you something you can never get back. Out-of-network billing. You do everything right. You go to an in-network hospital, you verify your coverage, and then, in the operating room, an out-of-network anesthesiologist, one you never hired, never met, never consented to, performs part of your procedure. The hospital is in-network, the anesthesiologist is not. That bill lands in your mailbox 6 weeks later and it is entirely legal. And here's perhaps the most elegant tool of all. The appeals process is not designed to be resolved. It's designed to be abandoned. It is paperwork heavy, time-consuming, emotionally exhausting, and deliberately complex. And the industry knows this because the industry designed it this way. A 2023 KFF study found that fewer than 1 in 10 denied claims are ever appealed. Of those that are appealed, over 40% are overturned in the patient's favor. Read that again. 40% of appeal denials get reversed, meaning nearly half of all initial denials were wrong, not ambiguous, not borderline, wrong. And the industry is banking, literally banking, on you not knowing that. Now let me show you where this started, because this story is not new. It just keeps getting repackaged. In the early 1900s, life insurance companies were caught doing something remarkably similar. They would sell policies to working-class families, collect premiums for years, and then when the policyholder died, dispatch investigators, specifically tasked with finding any reason at all, to void the policy. A minor omission on the application. A hobby considered dangerous, an undisclosed family health history, a pre-existing condition the deceased never knew they had. The Armstrong investigation of 1905 in New York exposed the entire machine. Charles Evans Hughes, later a Supreme Court justice, spent months documenting how insurance companies had turned death benefits into a legal obstacle course deliberately designed to exhaust grieving families into abandoning their claims. Sound familiar? The industry paid fines, promised to reform, hired lobbyists, and within 2 decades was back to the same structural incentives dressed in new language. A century later, the mechanism is identical. The vocabulary is different. The scale is incomprehensibly larger. $153 million in federal lobbying in a single year. Regulatory capture at state insurance commissions, where commissioners rotate between government roles and industry jobs like a revolving door with a salary bump at every turn. The medical loss ratio rule, which sounds like consumer protection, requiring insurers to spend at least 80% of premiums on actual care, has been gamed through creative accounting, administrative costs reclassified, executive compensation reframed as quality improvement. The number looks compliant. The reality is something else entirely. Karen is 47 years old. She runs a small business in Ohio and has been paying premiums on an individual health policy for 9 years without a single major claim. Then she gets breast cancer. She files her first significant claim in nearly a decade, and the insurer triggers a rescission review. What did they find? 7 years earlier, at a routine annual checkup, her doctor had noted in her chart that he asked about her family history of heart disease. Karen answered the question. The doctor noted it. Karen didn't think about it again. The insurer's lawyers called it an undisclosed cardiovascular risk inquiry. Policy canceled, premiums not refunded, claim denied. Karen is now uninsured, in cancer treatment, and holding a legal bill on top of a medical one. And here's the part I need you to hear clearly. Karen did nothing wrong. She answered every question honestly. She paid every premium on time. She played by every rule she was given. The rules were written to beat her. The most dangerous thing about this machine is not the 32% denial rate or the 1.2-second AI review or the $35 billion in profits. The most dangerous thing is that most people only find out how it really works at the exact moment they are least equipped to fight it. Sick, scared, running out of time. Here's where this stops being a history lesson and starts being a toolkit. Because the machine is powerful, but it is not invincible. And there are 5 moves available to you right now that most people never use. Move 1. Document everything. Every premium payment, every correspondence, every phone call with a reference number and the name of the representative. Every EOB, explanation of benefits, the moment it arrives. Insurance companies are betting on your disorganization. A paper trail is the single most powerful weapon a policyholder has in a dispute. Don't give them the advantage of your own chaos. Move 2. Treat every denial as a negotiating position. An initial denial is not a verdict. It is a first offer in a negotiation, and it is a first offer specifically designed to see if you'll walk away. Appeal every significant denial. The 40% overturn rate on appeals is not a secret. It is simply unused information. Every time you don't appeal, the industry wins a bet it made on your passivity. Move 3. Request the denial reason in writing. Insurers are legally required to give you the specific policy language used to justify any denial. Most people never ask. When you ask, the calculation on their end changes. If their denial doesn't hold up against the actual policy language, and frequently it doesn't, that documentation becomes the foundation of your appeal. Move 4. Demand an external review. This is the move that almost no one knows about, and it is federal law. Under the ACA, every insurer is required to offer an external review of any denied claim, conducted by an independent third party that is completely outside the insurance company's control. It bypasses their internal process entirely. It gives you a neutral decision maker. And the insurer's reversal rate in external reviews is significantly higher than in internal appeals. Most people have never heard of it. That's not an accident. You can request it in your denial letter response. Use those exact words. I am requesting an independent external review under the ACA. Move 5. Read your EOB before you need it. Most people read their explanation of benefits only when something goes wrong. By then, you're already behind. The exclusions, the prior auth requirements, the network definitions, the rescission clauses, these are readable documents. They are written in dense, deliberate language, but they are readable. Read them when you're healthy, when you have time to think, when you have the clarity to ask questions before the stakes are life and death. Knowledge is the only leverage you have in a system that was designed from the ground up to assume you have none. Here's the uncomfortable truth that I want you to carry out of this video. The insurance industry is not broken. A broken system fails randomly. This system fails predictably, profitably, and by design. The denial rates are not a scandal that emerged from negligence. They are a business outcome that emerged from optimization. The legal mechanisms, rescission, prior auth, step therapy, surprise billing, were not legislative oversights. They were lobbied into existence, one campaign contribution at a time, by an industry that understood exactly what it was building. The most important number in this entire story is not the 32% denial rate. It's not the $35 billion in profits. It's not even the $153 million in lobbying. The most important number is the one nobody is counting. How many people received a denial letter, assumed it was final, and moved on? My guess, it's most of them. And the industry is counting on it being all of them. Now you know better. Has a claim ever been denied on you? Drop your story in the comments below. I read every single one, and I'll personally reply with your next move. Comment right now. Let's hear it.